Okay, so we already saw that the statement from the Fed kind of crashed the stocks. So now Jerome Powell is about to actually speak. Honestly wondering if we're gonna do this, if we're gonna do the same thing, if he's gonna crash the market. So um, uh, if you go to, if you like search Jerome Powell Live or whatever it's called, you can probably see it. So maybe so you have all these
The design of this
all
villa is
these
quite.
places on YouTube, Google that you can get it. Um, so we'll see how the this plot reacts to Jerome Powell speaking. You know what? Let me make the how the hell do you do this? Uh, PBT increase line width matplotlib. I never use matplotlib, but soon the Fed chairman's gonna speak, and we'll see what uh, what this does to this Tesla thing. He already crashed it, unfortunately. Okay, so use line width equals 2. Let's do line width equals 2 equals 2. Let's see if this is changing. I'll do line width equals 3. Yeah, it's a little bit better. So I'll do a restart. You know, I'll just continue as is. So look at the chart. The Fed chairman's about to speak. Maybe if you have like you can go like Bloomberg Live or whatever on YouTube.
Thing definitive rather than flipping and flopping
And you get this guy about to speak.
Linkage of politics into monetary ability. But John, I'm sorry, there's
He's gonna
elections
speak and
to
it's gonna
which
go
was
crazy.
yeah.
so the answer is they got to start in March to get out front of the politics.
I'd like to see questions about that.
Here,
Thanks to the
this guy's in the
Powell on
room.
the first Fed news conference
Let's
of 2024.
Good afternoon.
see how much he'll crash the.
Squarely focused on
Look how he's
dual
crashing
mandate
this thing.
to
Look at
promote
this.
maximum
Look
employment
at this
and
crash.
stable prices for the American
What a
people.
jerk.
The economy has made good progress toward our dual-made objectives.
What a jerk.
Inflation has eased from its highs without a significant increase in unemployment. That's very good news. But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain.
Why does
To assure the American people that we are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2 years, we have significantly tightened the stance of monetary policy. Our strong actions have moved our policy rate well into restrictive territory, and we've been seeing the effects of economic
Look how
activity
crazy
and inflation.
him talking is like
As labor
making
market
the
tightness
graph
has
go
eased and
crazy.
progress on inflation has continued, risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments.
Yeah, so he's
Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.3%. For 2023 as a whole, GDP expanded at 3.1%,
I guess this
bolstered
guy
by
likes to
strong
crash.
demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year.
Anyways,
Reflecting
you guys get the point. There's a lot of crazy volatility.
high interest rates also appear to have been weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Payroll
Anyways, this guy
Nominal wage growth has been easing and
changes
job vacancies have declined.
changes the way the
Although
stock
the
market
jobs
goes
to workers
through.
gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose
Anyways, you guys get
2.6%
the
over the
point.
12
Things are
months
crazy.
ending in December. Excluding the volatile food and energy categories, core PCE prices rose 2.9%. The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary
Anyways, you
policy
guys
is
get the
putting
point.
downward
Things are
pressure on
crazy.
economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate,